All right, so in this video, as already explained, we will be breaking down market bias in simple terms. The first step is to understand that structure is king, and by structure we are referring to the simple market structure or the advanced market structure, and we'll pay very good attention to swing point. So I will explain with my trading view what they are. Of course, we understand structures can be uptrend or downtrend, and by that we mean for an uptrend you have to see a higher highs, higher lows, higher highs, higher lows. Price needs to keep making higher highs, higher lows, just like you can see in this pair. By the way, this is Oxy CHF, the daily time frame, right? I think I should start from that one. That to understand bias, you have to first determine the kind of trader that you want to be. If you are a day trader, then you want to get your bias from the daily time frame, the higher time frame, like daily, weekly. If you are a scalper or an intermediate short-term trader, you can drop down to say 4-hour time frame, 1-hour time frame, etc. All right, but for the purpose of the video, we'll be using the daily time frame, and I recommend this time frame for those who wants to be a day trader, right? An average day trader who might swing to some couple of pips. So we have here a typical example of an uptrend. So you see price makes higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher high, dipped in, took liquidity, create another higher high, higher low, and we're technically looking for this to continue the uptrend to take out that high. By the time of this recording, we're expecting CPI news, and you see I'm already projecting price to continue. So with just understanding market structure from the higher time frame, that is the key point. The higher time frame, you would most certainly know what bias is all about. We will move to other things in this video. So we also mentioned from our notes that you must pay attention to what we call swing point. All right, advanced structure and swing point. So for example, when we talk of advanced structure, we mean, for example, for an uptrend, price makes higher high, higher low, higher high. This is your simple market structure. For advanced market structure, price will not simply pull back and go up. This is simple enough. For advanced market structure, price will most of the times create substructures inside the main structure. So for an uptrend, you have price push up to create a higher high, pulls back for a higher low, right? Now it normally should go up and create another higher high, but most of the time it will create internal structures, and then goes up eventually to create that higher high you have anticipated for. It does this again this way, and all of those. Now and this is what confuses traders a lot. By the way, structures like this is what we refer to as advanced market structure, but that is what confuses a lot of traders, right? And that is why you must understand swing points. Swing points are the distance, or is a distance between in an uptrend, a higher low and a higher high. So this distance from this low to this high we refer to as a swing point. Now in an uptrend, we want to see higher highs constantly be broken. We want to see higher highs constantly being broken. Now if price comes back and takes out this higher low right here in an uptrend, then the tendency or the potentials or the probability that the trend has changed will increase. All right, so in a typical uptrend, we want to see higher highs continuously being broken. So note your swing point. Swing point tells you if the trend is continuing or there is a high chance of a change of trend. Very important. So you have this higher low, that higher high right there. Price pulls back to form another higher low. All right, now until price breaks that higher high, you are not continuing the uptrend. So you want to look out for that higher high to be broken for continuation. All right, so you can call those levels your swing point high and your swing point low. That becomes your swing point high, and this becomes your swing point low, right? Now, you want to pay attention to any of the swing point areas that price breaks immediately. So if price comes and takes this one out, the swing point low, then the probability that price has changed direction is high. But until that, no matter how price plays in this lower region, you are still in an uptrend. So price can do this, break this low. So traders will see this as a lower low, right? It breaks it again, and they think that's another break, and then price is going to go down, only for price to move up and boom, continues the uptrend. So you must constantly, as a trader, pay attention to swing points. Now, if you listen carefully, I use the word probability. I use the word the probability that price is changing trend once a swing low is taken out, or a swing point low is taken out in an uptrend, right? The reason we use that word is that many times price can take out swing point low but still not change trend. We call that liquidity grab, which we have done a whole lot of videos in our channel talking about that. So look at this example right before us. This is Aussie USD, Aussie CHF rather. Price moves up, so this is a new trend. Higher high, create this low. So it goes up, breaking that high all the way to that point, pulls back, goes up. So if you zero in down, you would see price creating series of higher highs, higher lows. Now look at what happened. Price came down, took out this was a swing point low that price takes out. The way and manner price takes liquidity is very important. We will talk more about this in subsequent videos. So the price came back to take out this liquidity here, but did not change the trend. It grabbed liquidity. How did we know? After it took liquidity, it reversed immediately to that high, create a swing high. All right, now inside this pullback, you have different things that makes it look like price is changing trend. Let's look at it more carefully as we move to the other phase. I don't want this video to be so long, but you need to really pay attention to what we are sharing. So this is your swing. This right here is your swing from this low, right? From this low all to that high. Now price pulls back to this level. Now we expect it to come all the way to that high. From here you already see market bias. However, this is where confusion sets in for a lot of traders. Look at this pullback. Look at this pullback. So price creates a low, pullback, broke it. So people will say, a lot of traders will say, the trend has changed to bearish. It has not changed yet. So long as this swing point low is still standing, everything here is garbage, it's pullback. So it did that, it pulled back again, broke another structure. You think it's not done with you yet. It pulled back and broke it a third time. And all of these happening induces traders to think that the trend has changed direction, only for price to what? Break up to the upside. It's going to do that after the news today. All right, now this is so important. From here already, you can already see, by this understanding, you can already start framing your bias. In fact, bias can be gotten when you understand swing points structure, which we have talked about. Uptrend, downtrend, swing point. Very important. Very important. It's very simple, actually. Very simple. Let's check our note. There are two other steps I'm going to share in this training. All right, let's look at the next step. So you must understand all of those structures and swing point. Number two, we'll talk about algo structure clarification. Algo structure clarification. Now, what are algo structures? Algo structures are simply what we refer to as sweep and break in the market frame. I will explain that. Algo structures are simply sweep and break in the market space. So that means that in an uptrend, you want to see price take out a low and break the corresponding high, this high. This bottom low that was taken out to refer to as a sweep of liquidity. This top break of structure, or this high that was taken out, to refer to it as a break of structure. All right. Now, what's the difference? The difference, it does not make sense whether sweep or break. The difference is that, first of all, you want to have a sense of market direction. I'll say that again. If you understand market structure, that price is bullish, yeah, and then you see a low taken out and a corresponding high taken out, just like this example, then you have the name in its right context: sweep of liquidity and break of structure. The major difference is that the distance, please pay attention, the distance from where this liquidity sweep happens, the distance between the sweep and the break is obviously wide apart. So usually the sweep will be smaller than the break. The break will usually have big momentum. Now, beyond all of these, of course, you can inverse it for the sell side scenario. What is the importance of algo structure in bias? Very important to know. What is the importance of algo structure in bias? So the importance is that once you have your algo structure inside your bias, the importance is that price will most likely not return back to that area that liquidity have been swept. Once you have an algo structure in your bias, the importance that price will most likely not return back to the low that was swept. So that means, for example, you are seeing price in a bullish market making series of higher highs, higher lows, higher highs, higher lows, and all of those stuff. Now, the moment you see an algo structure this way, sweep and break to the upside, right, you can be rest assured that this price action will not come back to this low again. There is almost no fear. So long as price remains bullish, it's not returned back to this low again until it meets its upside objective. And this is a classic example we are seeing right on the charts. Let me show you a very clean example right on this chart. So we are still looking at Oxy CHF as a case study, right? Now, this clearly here is an algo structure. Sweep, oops, that's not the right tool. You can see price, this low took out that low. So that's your sweep of liquidity, and this is your break of structure. Now, what does that tell me? Amongst other things, even though we are continuing the uptrend phase, it tells me that so long as we are still bullish, price will not come back to take out this low. Instead, if it's going to come back to play with something around this area and then continue its bullishness. Do you understand that? It's very easy. You just need to have it as a side knowledge, all right? But again, like we said from the step one, structure is king. You just need to understand algo structure. We have a whole video in this channel where we talk about our entry models and everything within algo structure. Then finally, you have to have an understanding of equilibrium, premium, and discount. All right, and then put all of these things together. Of course, equilibrium simply means midpoint. Midpoint. Premium means top half. Discount means bottom half. All right, equilibrium means midpoint. Premium means top half. Discount means bottom half. In a lame terms, equilibrium is the resting point of chart of price action, where price finds balance. Premium is the top half of any range where price will look to sell from. Discount is the bottom half of any price range where price seeks to buy from. So you must have understanding, even as you're looking at bias, you must have understanding of equilibrium, premium, and discount. And I'll give a very good case study as we wrap this video very shortly. Now, to get your equilibrium, premium, and discount, you must first of all know your price range. And price range simply means swing points from a low to a high, just like this already. So this low, that is a swing low, like it's also a swing point, and that's a swing high right there. So this, from this low to that high, is what your swing point. So bring your Fibonacci tool, plot it from, if you are bullish, please pay attention. If you are bullish, that means your bias is telling you bullishness. You only want to join that buy or bullish ride from your discount. So you must wait for price to pull back to discount before you buy. Price has to pull back to discount before you buy. If you are bearish, you wait for price to pull up to premium before you sell. Very important. The only exception to this rule is when you have your algo structure formed in between, and that's where I'll be wrapping this video on. So this is a swing low, that is a swing high. Now if you are getting so much value for this video already, please give it a thumb up and subscribe so that you'll be getting the notification when I upload the next video where we'll be talking about entries and every other stuff in between. Please encourage this channel by liking, subscribing, so others can get to learn about this stuff. All right, so you can put your Fibonacci tool from that low, extend it to the high right there. Now how to set your Fib tool is very simple. When you get your Fib tool, simply edit the values, all of the values in the Fib tool, edit them. All right, turn off all of the values and only turn on 0, 1 and 0.5. That's all you need in your Fibonacci tool. 0, 1 and 0.5. So the 0.5 is the midpoint, your 0 is the starting, and the 1 is the ending. So you have just these 3 indications. So what does that tell me? That tells me from this swing point that this midline is my equilibrium, and this bottom is discount, this top is premium. So you can see how price got to that high and pulled back all the way to discount before it is buying. You can be rest assured that once price takes at this point and goes to a certain level, it's going to pull back to another new discount and continue to buy. It goes on and on like that. All right, so that is the knowledge of equilibrium, premium and discount. Now I said that the only time where price will not actually pull to discount to buy or pull back to premium to sell is when you have algo structure formed. In our next video, I will take more time to explain that. So having this understanding of structure, it's king. Structure is king. I can cut off my chart, all right, and have a replay, for example, and you can tell the change of this market structure, Oxy CHF, from where it was bullish to from when it was bearish to how it became bullish. Now you can see clearly, as at the time of this price action, it was heavily bearish. Now it pulled back, grabbed liquidity, ran down to this area, right? Notice it did not take out this low, and that's already an indication that price may want to change direction. But how do you know? How can you tell if I'm here on this chart that price is about changing direction? So look at all of the swing points. This was a swing high, right? And this, in this instance, is a new swing low, right? Now none of these area was, so price pulled back, formed another swing high, and basically this is like consolidation. None of this high or low is taken out. So let's play price and see a very notable difference. Now notice again, from this level you have a swing high here, right? And it has a swing low here. So which of them did price take? Price takes out the swing high. So this is already indicating that the trend has changed, right? But you cannot be very sure until that major swing high there is taken out. So you must understand that all of these highs and lows inside, they are all internal structure. That's the last swing external, and this is the last swing external. Pay attention to those swing point, high and this low. So which of them will be broken? That indicates the change of direction. So let me fast forward this so quickly so we can see what happened. Clearly you see between this external low and external high, the high gets taken, and once that high gets taken, you now have a new swing range. And what is that swing range? From that new high created, right, and this low, this lowest low right here, not this overall, this one right there. And now you can pay attention to this range, the equilibrium of it right there. So you want to see price pull back into this 50% or below, and then the next buy trade continues. Boom. And that's how you have this. Price comes into the discount, and boom, the buy trade continues from there, and on and on. So I'm already looking for structure. I'm looking at structure. I'm looking at this range already. Same thing, pulls back to discount. If you look at that's discount, and then we are going there again. So it's very simple. Now it's okay if this does not make perfect sense to you, but please understand structure. Every time you see a high broken in an uptrend, just know you are looking for buy continuation. So you wait for price to pull back to discount and then you buy. In our next videos and subsequent videos, we'll talk more about bias, because once you understand direction, like this trade now, as at the time of recording, I'm heavily bullish on this guy all the way to that area, so I can hold all the way to the upside. And it's very simple. Once structure is understood, you have trading in your palm. Trading becomes boring and easy once you understand market bias. See you in the next video where we'll talk more on structure and entry. Bye for now.